Hey everyone, and welcome into today's video. My name is Jason and I hope you're all having a fantastic day. We are going to be reviewing Cathie Wood's new video that did just come out. I am going to try and get it down to around 5 or 6 minutes in this video as fast as I can to save you guys watching a whole half-hour plus video of Cathie Wood chatting away about all of the monetary policy and all the nonsense that is going on in today's market. All I ask in return for this video is that you go down there, smash that like button for me, hit that big red subscribe button if you are new, and welcome to this family of investors. So guys, I'm going to start by talking about the monetary policy is up 27% on the M2. Now, Cathie Wood did say that Jay Powell did come out and he was talking a lot about unemployment and also the homelessness, and she wasn't quite sure what that had in correspondence with the market, but she did say that CPI levels were being raised to around 3 to 4%, and again, if that was compared to this time last year, it'd be around 0%, so that is all going to be temporary, and again, that is going to lead to an increase in inflation. So the inflation expected is going to also cause a spike in the 10-year Treasury yields, which is what we have seen, of course, over these last few months, which is why the markets have entered a very unsteady time. She also said that the US right now is in $28 trillion of debt, and that is annualizing at $4 trillion every single year. So that is absolutely enormous. And Cathie did say that at some point in time, we are in fact going to have to pay for this, and we're not sure when that will happen, but it's something that she is not really worried about at this moment in time. She does say that the markets are going to enter a confusing time for the next 6 months or so, and this could all play out due to, again, that spike in the bond yields, and again, that's all due to the inflation fears. He does also go on to say that the tax is going to be upped on the wealthy, especially in the states of New York and California and all of those other kind of higher class states. She was also talking about that is going to be between a 21 and 28% bracket, and that's for people that, again, that are over 400k. And she says that the dollar is going up, and this was unexpected. They weren't expecting to see a stronger dollar, especially with all the money that is entering the economy right now. But again, due to this, that is why the dollar is in fact going up. And she says that the real economic activity has not been this high, guys, since 1994. So that was over 27 years ago. And we are having a very, very strong rebound, stronger than even she anticipated with her, you know, all of her investors at ARK Invest. And she is not going to worry about inventory issues, although it could lead to a doubling or tripling of inventories. That is not something that they are particularly worried about. They are loving the fact that, in fact, right now we are having a very strong rebound in, obviously, the recovery moving forward. Non-farm payrolls were expected at 660k, and they did come in at 916k, and work hours demand went up by 0.2 hours at the end of each month compared to 0.1. So that is some additional work hours, which means that obviously there is a big demand right now for people working, which is obviously a very, very good thing for the economy. And she also said a lot of investors in the tech and telecom bubble bust, you know, they were very short-sighted. They wanted their dividends, they wanted their gains now, they wanted it quarterly. So a lot of investors are very, very heavily focused, since obviously the telecom bust, on getting those, you know, very, very small profits straight away in their back pocket every single month by those dividends. And right now she is more focused on the new world, and she talks about good deflation and bad deflation essentially. And what she means by this is obviously the companies that are investing into those dividends, again, those are going to be the companies that will be value traps later on down the line, because they're not investing enough of their money right now in those innovation platforms. And again, we have 5 innovation platforms. We have FinTech, we have artificial intelligence, we have robotics, we also have energy storage, and we also have genomics. So these are going to be the 5 innovation platforms that Cathie Wood believes is really, really interrupting a major market right now around the world. And she says that the companies right now that are not investing in these sectors of innovation, in fact, are putting their shares back into shareholders' money through dividends and things. A lot of these companies are going to be hit very, very hard with obviously bad deflation, and that is going to affect obviously the economy moving forward. As these 5 innovation platforms actually come to fruition over the next decade, we are going to see good inflation, because what's going to happen is for every cumulative doubling, obviously, in genomic sequencing and DNA reading and all of these things, it's going to be cheaper over time. So what we're actually going to see is a decrease in deflation moving forward. And she did talk specifically about how obviously these sectors have rotated from growth to value, and she says the markets will find their time again, and the growth and tech sectors will once boom again. Financials and energy are up the highest year over year right now, I think around 28%. So guys, that is some news about the rotation. She's not worried, and she she is converting all of her eggs into her highest conviction plays, and at ARK Invest, that's what she's doing. And she says that the good, obviously, innovation technologies, that is going to allow things to retransition back out, obviously, once these innovation platforms start to disrupt these major markets moving into the coming years ahead. And she's really not worried about the short-term mindset, again, how the stock market is playing out. And they have done their research. They know that the Warren Buffett indicator, there was obviously a tweet from Elon Musk, and he was worried that the Warren Buffett indicator, if you don't know, obviously measures the total market cap of equities in the market, and it is divided by the GDP, and that is currently at all-time highs of around 25 to 30. And she's saying that right now, even though it's at all-time highs, this could sound absolutely crazy. She said it could go up even more, and she says this is all due to the fact that the ratios are like how it was around in the 1800s, where there was so much innovation right now, so market caps didn't really matter, because obviously moving forward this innovation was going to interrupt the markets. And she says obviously as these 5 innovation platforms come into effect, the ones that we had talked about, these are all deflationary forces pulling down that denominator relative to the market cap. So this means that the Buffett ratio will actually go up in the future, and we could see price to PE ratios, you know, as high as 35 or even 40, and this would actually be normal for the market. So right now a lot of people think the valuations are very high, and she thinks that this, I know, is very crazy to say this, but the valuations could get even higher. And again, this is moving over the next couple of years. This isn't something that is going to happen right now, obviously in the next couple of months, but moving forward, because obviously the costs associated will decline over time, that will actually pull the deflationary forces down, and that will also pull inflation down with it. So that is where we can actually expect to see, you know, these innovation platforms really taking off with their market caps and also their ideas, and that's where we are going to see a high price to PE ratios. And she says obviously long-term treasury yields will stay between 2 to 3.5%. That's where she thinks they are going to stay. And so that is all that she has basically said. So I'm very happy moving forward again to keep my money in a lot of these high growth plays. It is always worth making sure that your portfolio is diverse and having obviously your eggs spread out. But Cathie Wood is a strong believer in her high conviction plays. She is saying that the new world is going to be about innovation and growth, and she's really not worried about the short-term mindset of how investors are investing right now. The S&P 500 is made of, you know, 50% value traps that will, moving forward, unfortunately see some big changes. So that is what is happening, guys. I'm very happy to give you all this information. I hope that you did enjoy this short video today. If you did, then be sure to go down there and smash that like button and join us by hitting that big red subscribe button below. I hope you all have a fantastic weekend ahead, and I will look forward to seeing you guys back on my channel soon for some more content on investing. Ciao.